Hello, everybody. My name is Lee Schwartz, and I'd like to welcome you to our virtual business discussion. Today's topic is post-election year-end tax planning. Now, I notice a lot of familiar names on the attendee list. I know a lot of you have been attending our past webinars, and we're excited to continue bringing you this important information. So we'll jump in here in just a sec, but a couple of quick housekeeping items. If you have a question during the webinar, open up the chat box in Zoom and submit your question to all panelists. We are going to leave time at the end for Q&A. Also, we're recording this webinar today. You'll receive an email with a link to a survey, as well as our SVA resource page, where the webinar recording will be available. And you can feel free to share that with others as well. Now, many of you are already clients of SVA, and we'd encourage you to reach out to your SVA contact if you have questions coming out of this. I'd also encourage you to share our contact details with other business contacts who could use our help. Over the last 8 months, we found that there are a ton of businesses and nonprofits who aren't getting timely or knowledgeable advice from their CPAs or advisors, and we're happy to help. If you're not a client and have questions, please reach out to me and I'll connect you to the SVA subject matter expert who can get your questions answered. Well, here we are on December 1st, which means that we're close to wrapping up this interesting year. We've dealt with a global pandemic and a presidential election, both with ramifications that are still uncertain, which makes tax planning in 2020 even harder than years past. So today we're going to talk about what you need to know at this point in time. If you've attended our past webinars, you're already familiar with Dan Glomsky. Dan is a principal with SVA and has been one of our main presenters over the last 8 months with our PPP and our Back to Business webinars. And Eric Trost is a principal and works with organizations and their owners to minimize their taxes. So I'll be back in a little bit for the Q&A, but Dan, I'm going to let you take it from here.
Perfect. Thanks, Lee. All right. So today we want to cover basically what we kind of have as our top 10 possible tax changes that might be part of Joe Biden president's positions. And what we want to do is we want to cover like those things on a surface and see if we can give you some tax planning things to consider, recognizing that these are not any laws at this point. Really kind of our speculation or predictions of others as well on what the agenda of Joe Biden might translate to. And then we also want to touch upon giving some update to the PPP loan. I know you've received a lot of information on that over time. There's been some current developments we just want to make sure that everybody's aware of. So as we get into this presentation, the primary objective is of Joe Biden in presidency would be to generate some additional revenue. And at this point, the things that we're going to talk about kind of lend to about 2.4 to over 3 trillion in revenue over a 10-year period. So we're not talking like this is going to be, he's going to go into presidency and then right away we have these tax law changes. We'll get into some of that detail as we go, but we're going to focus on the top 10. We're going to first focus on what we believe is going to be the corporate changes that might be in the immediate future. And again, we'll go into when the timing of this stuff, when we should be looking for it. But what we're going to do right now is share what we know. And so based on Joe Biden's platform, number one thing on his agenda for the corporations is to raise the rate to 28%. When I say corporations, I'm talking about C corporations. So C corporations, entities that pay the corporate tax to them directly from the corporation. Currently, the tax rate for a corporation is 21%. And Biden would propose at this point to increase that 28%. So what does that translate to? And what that translates to is about 727 billion in revenue generation. So you're going to notice on a lot of these topics, I have added a level of revenue generation. And the intent of that is to kind of give you some perspective as far as what they're looking for and, why it might be a priority and, depending on how much revenue we're looking to generate. So that's the context of that message. But I think it gives us a good indication of really what what they're really trying to get at when they're changing these things from like 21 to 28%.
So yeah, thanks, Dan. A little more on this 28%. The corporate rate used to be just several years back, 35% as a top rate. And then Trump put in tax cuts in 2018 that lowered that rate all the way down to 21%. The idea was to get it to 20. Eventually there was compromise to get it to 21%. And so now this would be a walk backwards or a walk back up, depending on how you want to look at it, to get it to 28%, which is now in line, I think, with more developed countries that typically have corporate tax rates between 20 and 30%. This is going towards maybe that top end. So I think what's going to happen here is, while it may not get to 28, maybe it will. I think there's going to be an increase from the 21 ultimately in a final tax package.
Yeah, and the reality is we're going to present, we have top 10, right? And there's another element here. You might hear say, well, Joe Biden's going to bring back AMT and so forth. And there is a reality to that. If one of his agenda items is to bring back AMT, but it would be for companies that have net income over 100 million, and it would be based on like book income. So there's different theories that are out there with respect to his agenda that we may not cover in this slide, but definitely a lot of points to talk about. Number 2 on our list is
actually, Dan, you mentioned AMT. I just want people to know that that's the alternative minimum tax. That's a special tax calculation that would kick in for companies that are paying very low tax. There is no alternative minimum tax for corporations right now. That was part of the repeal in the Trump tax cuts back in 2018. So there is no alternative minimum tax for corporations right now. Joe Biden is talking about moving back into that alternative minimum tax, or AMT, calculation, but only for corporations that have more than 100 million in income, book income.
Yeah, a great point. Way to clarify that, Eric. So then the number 2 on our topics is the limitation of the 20% qualified business income deduction for S corps, partnerships, and sole proprietors. And we're looking at this provision of adjustment to account for 143 billion. This limitation would impose upon individuals. So to back up a step, the qualified business income deduction is a 20% deduction for qualifying businesses, and it's limited to wages, and it's also limited to businesses that are not service businesses for the most part. But it would limit the deduction. You'd be able to get that qualified 20% deduction until you reach about 400,000 in individual income. And once you go above that, there might be a phase out provision and so forth. So basically, you're going to see a kind of like a holistic agenda here of 400,000 is basically the wealthy, and everything below 400,000 is who Joe Biden, in essence, is looking to kind of preserve some of the tax incentives. So you'll see the 400,000 topic quite often. But what we're looking at here is, that limitation on pass-through entities.
Yeah, and so just a reminder of what this is, it really ends up being a lower tax rate for entities that are operating as pass-through entities. Lower tax rate than, say, wage income. It's really a break on your income taxes by holding your business as a pass-through entity. So a question's come up of, what kind of entity should I run my business in now, given these recent changes or proposed changes? So back prior to the Trump tax cuts, the answer was usually, let's run it in a flow-through entity because of the double taxation that hits C corporations. After the Trump tax cuts, the corporate rate went way down to 21% versus 35%. And there was this 20% qualified business income deduction that was allowed for flow-through entities. That made it pretty close to a push. Still probably better as a pass-through entity than a C corporation. But we had entities that would look at it and maybe evaluate and say a C corporation is better for us. Now, this might change that landscape again if these changes go through, making the flow-through entity, the S corporation, the partnership, the LLC, a better entity of choice than the C corporation by a more significant margin. So where this all comes in is, if you're asking yourself, what kind of business entity should I have if I'm considering restructuring? These are the kind of changes that are going to affect that answer.
Yeah, we did a ton of analysis when the corporate tax rate went down to 21% to see whether an S corp is still or an S corp or a partnership is the right entity as far as a tax efficiency perspective. And I think for the most part, we concluded that the pass-through entities were still the more tax efficient model. But we definitely saw the narrowing of that benefit. And certainly if the corporate tax rates now go up to 28%, then I think that changes our analysis even greater to being the pass-through entities might be the more efficient tax model. But again, each situation has to be evaluated on its own, and there's other circumstances that can play into that decision.
Yeah, like for example, if the corporate tax rate just goes up to 25% and there's a repeal of the 20% qualified business income for pass-throughs, that might actually favor even more a C corporation.
Right, exactly. So, so that's why we're trying to present these things today, give you guys some talking points, things to think about as you go into the years, whether it's 2020, 2021, but in the near future. The third corporate adjustment is more of a revenue generation. And I'm not, from a tax planning perspective, there's a reason that a lot of businesses have, subsidiaries and other things in other countries. But what the number 3 is a global intangible low tax income. We call it the GILTI tax. And currently it's a 10% tax on basically assets held in other countries or income left over in other countries. And under the proposals, we're looking at an increase to about 21%, a fairly significant revenue generation of $705 billion. So it's definitely going to be a fairly high ticket item. And we'll get into some other things about offshoring and onshoring incentives and costs. But this is part of that, kind of bringing things made into America, kind of putting things in the United States.
Yeah, and so before 2018, which was the Trump tax cuts, there actually was no tax on a U.S. corporation's ownership of a foreign corporation. There was no tax on that foreign earned income unless that income came back to the United States. And so with the Trump tax cuts came in a tax on corporations that had subsidiaries in foreign countries that wouldn't remit that money back to the United States because they didn't want it taxed in the United States. And that tax rate was 10%. And now Joe Biden, in his proposal, has that tax rate going up to 21%. Effectively, what it is doing is giving less incentive to U.S. corporations to own foreign corporations and keep the money over there. The incentive now, which used to be a huge incentive, went kind of away with the Trump tax cuts, and now it's going to even go further away because owning a foreign subsidiary and keeping money there is losing benefit because now you're going to have to pay tax on that income anyway. And this combined with some of Biden's other onshoring and offshoring credits and deduction allowances is really a continuation, I think, of what Trump did, which is let's make tax incentives, let's make tax policy that encourages U.S. manufacturing at the expense of those companies that are offshoring their manufacturing or doing foreign manufacturing. So this is done through sometimes tax policy, sometimes it's done through trade tariffs or trade agreements. You see Biden kind of on a continuing plane here, which is really different than the free trade agreement presidents that preceded Trump, that being Bush and Clinton and Obama, who really kind of looked at free trade agreements as the way to go for the economy. And then Trump came in and really said, this is more of a, we have to do made in America again. And Biden's continuing that, at least with this tax proposal and some of his other proposals regarding onshoring and offshoring.
All right, so now we're kind of transition into the individual tax items. And these, you know, from a business perspective, right, when we have pass through income, you know, S corps, partnerships, sole proprietors, right? That's where the individual items start to also factor in. And then there's a few other items that we've talked about or that the press has talked about quite a bit. Number 4 was the increase in tax rates from back to 39.6, which really started from the Clinton era, and Obama also, you know, resumed that level. And currently we're at about 37%. So as the top rates. So we're literally looking at, you know, some level of increase here. I think it'll be more of a bracket adjustment, and we'll have to see what those brackets also look like. But again, remember me saying the 400,000 is kind of where we see a lot of stakes in the ground. And again, we're talking about Biden's platform. You know, the president doesn't actually set the tax rules or advance those items. It has to go through the House. And so we see a lot of you can see a variation, but we would expect his agenda to kind of be assumed by the House from that perspective.
Yeah, and so on this slide, it says restore the top tax rate of 39.6 from 37%, as if somehow it needs to get back to 39.6% as some kind of normal. That really was a rate that Clinton had back in the years, and then was lowered by Bush, and then increased again by Obama. And now Trump has gone back down from the 39.6 to 30.37% in the Trump tax cuts. So whether you call it restoring or not, I would just call it an increase in the top tax rate by 2.6%. But this combined with, if the qualified business income deduction is repealed for upper income taxpayers, really raises their rate from 30%, which is what qualified business income is currently taxed at, to almost 40%. So it's somewhat a significant tax increase for the upper income taxpayers. And I think you'll see that theme throughout the Biden proposals, is they really are attaching to those upper income taxpayers, and this would be one of them.
So number 5 is more of a topic that affects a lot of people in the past. Under the current Trump tax reform, we see a lot of people using a standard deduction versus an itemized deduction. But there are situations where we have a lot of charitable giving, might have mortgage interest. We know that right now the state and local tax is limited to 10,000. So maybe that's not necessarily a driver under, you know, assuming the SALT provision, state and local tax stays at 10,000 as a limit. But what the current proposal would be is to impose a limitation so that the itemized deductions cannot exceed 28%. Now, when I say revenue generation of 163 billion here, that's the increase in tax rates. And it doesn't factor in what Eric talked about with respect to the 20% limitation. That was talked about on the prior slide. The 163 billion is the increase in tax rate by, you know, 2.6% plus the limitation itemized deduction. So again, it's a significant revenue generation, but yet how few and far it gets applied is the next, you know, item.
Yeah, so I think, Dan, there's a couple of things on this. One is the state income tax limit right now is $10,000. There's also a proposal that limit would be done away with. You know, folks in high tax paying states such as New York and California don't like that limit of $10,000. Those happen to be also states that I think are strongly supportive of Joe Biden, and he might support them back by getting rid of that cap, which would mean a lot more people would itemize deductions again, because there would be no $10,000 cap on their income and real estate taxes for a deduction. Having said that, this 28% really means that in the past, if you were in a top tax rate, and say that top tax rate was 39.6% or 37%, and you had a deduction for $1, the value of that deduction was the top tax rate then, 39.6 or 37%, so 39 cents or 37 cents. What this proposal would do is limit the value of that deduction to 28 cents. So even if you were in the 40% bracket, then your deductions would really only be worth 28 cents on the dollar instead of 40 cents on the dollar. So that's the effect of this proposal. And then by restoring the PEAS limitation, which is, what's the PEAS limitation? It's not the vegetable. It's named after a guy who said, hey, for upper income taxpayers, why don't we just reduce their overall deductions by 3%? Just picked a number out of the air. And so that limitation was repealed in the Trump tax cuts. Biden wants to restore that PEAS limitation, which means that your itemized deductions would be reduced even further by 3% if this limitation were to be put back in.
Yeah, and one thing that we talk about the SALT limitation of $10,000, and for one thing that we have the opportunity for in Wisconsin, if you have a pass-through entity, a S-corp partnership, is being taxed at the entity level for the state of Wisconsin, which shifts your Wisconsin tax expense deduction from this itemized deduction limitation to an actual business deduction. So if that's something that you haven't considered or haven't been doing, that's something that you should definitely entertain. And if this were to come into law in the future, and as Wisconsin entity election still exists, that might be another benefit of making that election. Now, I'm going to caveat that by saying that, making that election, there's got to be an analysis because you pay a higher state tax rate you pay 7.9% versus maybe the individual tax rate is 7.65. So you pay a little bit more in Wisconsin taxes, but the benefits at the federal level might produce a better savings for you. So that's one planning opportunity that exists currently, but also might be productive in the future. Number 6 is the capital gains. And I think a lot of people have heard about this, that, there's an elimination of capital gains rates. And the possibility of that is, as it's kind of laid out, is anybody over $1 million in income would, the capital gains would then be taxed at ordinary tax rates. So that is something to keep our eyes on, and it might determine your timing on doing particular transactions. So we're looking at this being a $373 billion in revenue. Again, a substantial amount of revenue being generated. So we think it's a fairly significant item that could get some attention.
And I see this as a significant tax increase for large capital gains. So if you had a capital gain position with more than $1 million of potential gain on it, getting it taxed in the 2020 year, the tax rate's going to be 20% on it. Getting it taxed in a year, if this proposal goes through, the tax rate could end up being your top tax rate, which could be 40%. So, this is a significant tax increase, especially for those with large capital gains. For example, folks selling real estate or selling their business. If there's any timing to be considered here, this one would make me nervous if I was putting it out further, if I had the option to take it into account in the 2020 year.
Yeah, and we'll get into the, the timing of things and so forth as far as, when the reactions might need to be happening. But, Eric's point really is that, 2020, we know what the rules are. We don't expect any retroactivity to 2020. And then we'll discuss 2021 in a few slides. But the reality of it is, we know what today looks like, and that might be the opportunity if it's in front of you. But if it's not, then, relook at the next year and we see what our agendas or our possibilities are in the next year.
Yeah, Dan, that's a good point is, what we're talking about, what potential Biden changes could happen, the earliest they could be effective is 2021. There couldn't be a tax law that goes retroactive all the way back to 2020. That would be a historic change if it ever did happen. If it does happen, I'll be fairly busy, but I also might move to Canada.
It's a good spot for you, Eric. So then next, let's talk about the estate tax. And I think that one got some press as well. So we got two really here. One is the proposal to increase the estate tax rates from 40% to 45. And what the estate is, it's really gift and estates. And what you have is if a person were to pass away, there's a certain exemption that the IRS gives individuals, that if their assets are below a particular level, that they don't pay any estate taxes. But if they pass away and their estates are greater than that exemption amount, then they have to pay estate taxes. And that would go, currently we're at 40%, that would go to 45. The other thing that goes along with this is that exemption that I was just talking about is being, tossed around, that it would be reduced to the 3.5 million versus the current 11.8 or 58 million for everybody, per individual. So it's a significant impact if it gets the traction that we believe it could get.
And I think this is also a fairly significant one. If you look at where the Trump tax cuts moved this lifetime exemption to, the lifetime exemption is now 10 million plus inflation, which is really how you get to this 11.58 million per person. So what happens is a married couple can basically have about 22 million of assets or under. And if that's their amount, there's no estate tax that would apply. So under current law, the estate tax applies only to those that have more than this 22 million or 23 million in a taxable estate or total net worth. Lowering this to 3.5 million would mean lowering it to 7 million for a married couple. So let's say you have a married couple that has a estate value of 20 million right now. That estate value would generate no estate taxation. Everything would pass through to the beneficiaries or the heirs or the kids without any estate taxes being paid. If all that happens is this number of 11 million goes down to 3.5 million, then that estate now has a value of 20 million, less that 7 million floor that you don't have to pay estate taxes on, or a taxable estate of 13 million. And at a tax rate of 45%, that's about $6 million in estate tax that would have to be paid on, we'll call it at death. And I think that tax increase alone, if you're in that kind of position, should have you thinking about doing some gifting prior to the end of the year. So that's another timing issue, that if you're falling in that area, you may want to consider making some gifts prior to the end of the year.
Yeah, and Eric and I were talking about this, and although it appears that there's a significant consequence to a lot of people, the amount of revenue generated by these changes historically haven't been that significant. So we looked at the corporate changes that have 700 billion of change of revenue generation, and we don't know the actual number, but we believe it's around maybe 16 billion that would be created by this tax law change. So with that being said, it's something that may be on the agenda, but may not get as much attention, or variations of it might get approved, right? So they might say it's 5 million for an exemption, or we're going to keep it at the 40% rate. So I think there's room for compromise on this particular one, because we're not talking about a lot of revenue generation.
Yeah, I'd say this one is more about politics and optics than really revenue generation. A cut to the estate tax, who pays the estate tax? Well, only the super wealthy. So a cut to the estate tax is really a tax cut for the super wealthy. It's hard to get that through sometimes. It's hard to campaign on, I'm going to cut taxes for the rich. Nobody really wants to say that.
And there's other estate issues that are on the proposal or in the agenda cutting room, but we'll see what ultimately comes out of that. The next area is a payroll tax item. And what you'll see here is a fairly significant revenue generation. We're looking at 740 billion over a 10-year period. And the proposal is out there that is Social Security taxes, which is individuals pay a 6.2% Social Security tax, and the employer also pays a 6.2% Social Security tax. So we're looking at a significant amount. So we're looking at 12.4% of tax on wages. And currently the Social Security, you pay that 6.2% up until about $137,000. And then what they're proposing is when it stops at 137, it doesn't start up until somebody exceeds 400. But if somebody has compensation over 400,000, that would now be subject to Social Security taxes up until infinity, as much as that compensation is. So again, really targeted at people pulling in a fairly significant salary and has a fairly large revenue generation. So I think this is something that's going to get some attention. Again, whether it stays at 400 or kicks in at $1 million, I think that's to be determined. But that's something that you want to be mindful of. And again, it's maybe here's where a pass-through entity might be an option for you to maybe kind of still get the amount of cash flow out of the business that you want, but maybe get a slightly different tax treatment.
Right. And so this is another, what I call potential significant tax increase for those making wages over 400,000, because it's an additional 12.4% tax on each dollar over 400,000 that currently is not taxed. So, if you're making $1 million in a W-2, that's a pretty big tax bill that you're going to have that you wouldn't otherwise have with this kind of proposal.
Okay, so then we're going to hit number 10. Not a lot of excitement on this one, but we've kind of hit you with all the tax increases or tax changes from that perspective. So for number 10, we thought we'd throw a little bit of, well, what's in it for us? And well, there's a couple incentives being issued here or thrown out there, an increase in child care credit, child tax credit, then the child care credit. They've introduced a family caregiver credit. We're looking at housing incentives to purchase a first-time home buyer, but also some rehab in distressed areas. So there's credit proposals out there, and then energy incentives, right? Going to green energy, maybe a penalty on fossil fuel, that type of thing. But we're looking at those types of incentives. So that's, maybe this is the good coming out of this, but if it even is valuable to some people.
Yeah, there's a couple things in here to mention that housing incentives credit. There used to be a housing incentives credit several years ago. There was a $15,000 credit for first-time home buyers. That's the credit that they're talking about bringing back in again. So Biden has a proposal that first-time home buyer credit come back, and that was a $15,000 credit for first-time home buyers that initially was you had to repay it, but then a year later they made that credit essentially not repayable, so you didn't have to repay it. That's the version that Biden was looking at. Is it would be a $15,000 non-repayable credit for a first-time home buyer. There's also a renter's credit out there that Biden's proposing that would be a credit against rent paid for lower income individuals. So I think from a real estate standpoint, these are both things that would be drivers for both the housing market, and I think landlords would want to have this credit out there, as well as they want, if they have lower income properties or lower income tenants within their properties, those lower income tenants might be eligible for a renter's credit that would in effect subsidize the rent that was being paid by those lower income tenants.
So we picked the top 10, but there's always more that we want to talk about, right? So we threw this other topic in there, just trying to get a little bit more. There's also some discussion out there as far as increasing enforcement, auditing of high income individuals. And so they're estimating that, those two kind of spends, because I think their intent would be to increase people count in that level. So we're looking at about 36 billion in raised by an increase in revenue or spending in this case. Then we have the tightening of classification of workers as employees versus independent contractors. And where the benefit there really is if somebody's an independent contractor, they get their wages or income, and then they take deductions, which reduces the amount of self-employment taxes due on that. And I think that is, an opportunity for them to generate some revenue. And in this case, it's estimated to be about 11 billion. Again, might not get a lot of traction, but it's out there. And then there's a 1031, forget the slash, but it's code section 1031 exchange, and that is real estate is currently the only thing that can be like kind exchanged. And there's a possibility that that would be eliminated for people over a certain income level. And again, I think the amount was 400,000 that was proposed out there. Could have been $1 million, I can't remember specifically, but we're looking at the 1031 exchanges being somewhat of a something that might go away or be out there. And then onshoring and offshoring, here we have, possibility of getting incentives if I'm onshoring revenue generation or business activities versus offshoring. I might be imposed a penalty for moving jobs to another country from a corporate perspective.
Yeah, so I think, a couple things shorthand on this one is that the intent to tighten enforcement on those high income individuals, you can read that as they're going to hire more IRS agents to send out more letters and ask you more questions if you fall into the high income area. The tightening the rules on the classification of workers, there's been a lot of fights about this. And you think of a couple of companies, Uber and Lyft. Those companies are, have grown substantially in size as far as the people working for them. And those people working for them aren't employees, they're independent contractors. And Uber and Lyft like that, right? They don't want to have employees because employees mean employer payroll taxes and benefits and a whole set of laws you have to deal with when you have employees, as opposed to when those people are independent contractors. And I think the big fight in California, California was saying they're employees. Now, I think California has stayed that decision until they can figure out a workaround, because Uber and Lyft had threatened to pull out of California. That's how serious the matter was to them, is that we're just going to not service California if you have to treat these people as employees. So there has been a lot of fights about this, which I think will continue as the cost of having an employee versus the cost of having an independent contractor, as those costs escalate, as payroll taxes go up, as the employee minimum wage goes up. You're going to get, I think, more fights in this. And this tighten the rules. Biden is proposing tighten the rules on it, meaning that even more people should be, that maybe are currently classified as independent contractors, maybe they should be employees. So you'll see that come through. And typically when we're talking to small businesses, they may have no employees. And our advice is, don't hire employees, hire independent contractors. Don't have employees until you absolutely have to. Why? Because once you have employees, then you have employer payroll taxes. You have all the administration that goes with that. You have retirement plan considerations, healthcare considerations, or health insurance considerations. So taking on employees, especially taking on your first employee, is a big step for a small business. And the longer you can wait to do it, I think financially, the better off you might be. These rules, if they get tightened up, might force small businesses to have to say, we're taking on employees earlier because the classification just won't let them be independent contractors anymore. A note on the 1031 exchanges. This could significantly slow down the real estate industry. If there's a lot of property out there where the owner has a low tax basis and there's value to that property, if they would sell that property, there'd be a gain. And one of the exits from that gain, or one of the ways to defer that gain, is through the use of a 1031 exchange. If the 1031 rules are repealed, they're going to see a significant reverberation through the real estate industry, including the industries of the promoters that sell vehicles to complete a 1031 exchange. The TIC interests, the Delaware statutory trust interests. There's a whole cottage industry out there of these types of interests that can be used to satisfy a 1031 exchange. Well, if 1031 exchanges are gone, that industry is gone as well.
All All right, so we'll move on to what we view as, when we'll receive when and will receive changes. And, in the effort of time, we got a couple of things we want to talk about, the PPP loan and so forth, and maybe open some questions up for some questions. But what we're really down to now is the runoff in Georgia, which is January 5th. And what we're looking at there is there's two seats, two Senate seats that are out there. If the Republicans were to win one of the two spots, then they would maintain majority of the Senate and then would create, kind of a lame duck legislative situation where, nothing can seem to get to the, to law change. So we'll be seeing what happens here. Even if we see both seats go Democratic, we still think that it's going to probably push off the timing. So we know right now, 2020, right, the rules are what they are. 2021, it's maybe a 50-50 proposition if the Democrats were to get both of those Georgia seats. If one Republican takes and wins that a seat, then I think we're looking 2021 might be a tough legislative year for Biden to get some of these changes through. Eric and I also talked about the fact that legislatively, we think the agenda is going to be some kind of stimulus bill first, and then the revenue and so forth. Because there's some discussion that the tax changes that Biden's proposing could have an economic effect. And really, is that something that we want to spark in the recovery phase from the pandemic?
Yeah, and so Dan, why is that state red? Is there a meaning to your red or blue there, or is it
We
just?
got to throw color somewhere, right? No, that's our big Georgia state, right? But
but why red? Why not blue or a different color?
Oh, I didn't know, Eric. I thought you were colorblind, so I'm surprised you even knew it was red. But yes, it's.
I can only see primary colors.
Yeah, it's the graphics. So, but yeah. So I guess maybe I'm selfishly hoping for a Republican seat to be victorious there. But
Are you going to go down and do some campaigning in Georgia?
yes, right after this, I'm splitting off to take that on.
Right. I know some folks that said they're going to move down there. So, where the balance stands right now, the House is going to be Democratic, although less Democratic than it was prior to these elections. And the Senate has at least 50 Republican senators. Democrats have 48, and there's these two open in Georgia that we should know after the end of the year, though, how they go, because their runoff election is, I think, the first week of January. At January 5th here, Dan has on here. And, the thought would be if both of those Senate seats go Democratic, then it's a 50-50 Senate, and the vice president gets to, break the Senate tie. So effectively, you'll have Democrat control of the House, the Senate, and the presidency, and they'll be able to pass what they want to pass. Although I don't think it's that easy, because when you have a 50-50 Senate, if just a couple of Democrats would break away from that 50-50 and say, hey, we're not going to go along with some of these things, you lose your ability to just swing things through. And so what happens, I think, is in a 50-50 situation, any one senator on the Democrat side has a little more power than if it was 60-40 or 70-30, because any one senator on the Democrat side can hold things up and ask for different pieces of what they consider important to be put in a piece of legislation. That always slows down, I think, the legislative process. And so that could happen even if there's a 50-50, even if Democrats take both those Senate seats in Georgia. Now, if you go to the betting websites, I think the betting websites have it being about 75% that at least one of those seats is going to go Republican. Not that I actually partake in the betting. I just use that as a measurement to see where the public sentiment is on what they think is going to happen. So if one of those seats does go Republican, that definitely is going to slow down the legislative process. And, what's the point of it going fast or slow? I think the slower it goes, the more unlikely it is that a change can be retroactive to January 1st, 2021. the slower that tax legislation goes, the more likely it is going to be passed. If it is passed towards the end of 2021, I think it's just going to be really hard for a retroactive tax increase at that point. The last retroactive tax increase, some of you may remember it, I was practicing when it happened, was in 1993 when Clinton took over his presidency. He became one of the first presidents, and maybe he was the first, to have a retroactive tax increase to January 1st of 1993. Now, if you remember when Clinton came in, he had a significant majority in both the House and the Senate when he came in. He lost that majority 2 years later, but he had, when he came in, a significant majority, much like Trump did when he won the presidency, much like Obama did when he won the presidency. What's different this year is Biden did not get a significant majority of Democrats that won. In fact, the House went backwards. The House lost some Democrat seats, and the Senate, if it does end up with a Republican in that seat, really the Senate stayed Republican. That doesn't happen very often where you end up with a split government after a presidential election. Happens all the time in non-presidential elections. Doesn't happen very often in a presidential election. So this is going to be kind of a unique presidency, at least for the start, assuming Joe Biden does become president. He's really the president-elect right now, I believe. Assuming he does become president, this is going to be kind of a different start for him. He's not starting with the same advantages, I think, that some other presidents would start with when it's a one-party government, at least for a couple of years.
Right. So we got about 15 minutes left. We'll cover, maybe five or so minutes on the PPP updates. And because, again, we believe that these are things that impact a lot of businesses, we want to make sure that you have the most current information from our perspective. So one of the recent developments was that any loans that were over $2 million for PPP loans, if you're a for-profit organization, there's a form 3509, which is called a necessity questionnaire. And really this is the SBA's opportunity to kind of evaluate and check on that good faith sign off that we made when we had filed the application that we needed these funds and we had the uncertainty of our business and so forth. At this point, it's a little early to see what those questionnaires ultimately produce. Whether the SBA ultimately goes back and says, no, we disagree with you. You did not have a necessity to take this loan. We're going to ask you to repay it. So right now, if you have a loan outstanding for greater than $2 million, what's going to happen is when you submit your SBA application or the forgiveness application to your lender, within 10 days, you should probably be prepared to provide them with this questionnaire as well. Yeah, in theory, the SBA would request the lender to request the document from you, but you have 10 days to produce that document. So we always recommend everybody produce that currently and be prepared to send it off. But it's also something I think you want to be thoughtful when you complete. Obviously, you want to be honest on that questionnaire, but you also want to make sure your message of documenting your uncertainties and your financial position as best you possibly can. So don't take that questionnaire as I'm just completing it and sending it in, because it could have a consequential impact to your forgiveness.
Yeah, I'd also say with that, the SBA has announced they're going to audit any loan over $2 million. Now, the SBA used the term audit. In what sense did they use that term audit? Is it going to be like an IRS audit where they're going to send someone out and look at all your books and records and make some kind of judgment determination on whether you needed this money or not? Or does audit mean they're going to review this questionnaire, and that could be the extent of their audit? They could use this questionnaire as essentially like a filter, which is, I think, where they're going to go. And this questionnaire as a filter, they're going to pick out certain questions or a certain pattern of questions that I believe is then going to give them an idea of where they think they should look. Certainly, they're going to look for fraud. They don't want people that applied for these loans and backed it up with false documentation to get away with it. So they're going to look for fraud, and they're going to punish it, and they're going to publicize that too. So the fraudsters out there, do have reason to concern, because this will be made public, and I think it will be somewhat of a spectacle for them. But they're also, depending on how they run the program, going to look for companies that maybe didn't need it. And they call this the necessity questionnaire for a reason. That's where we don't know how they're going to pursue. And so these questionnaires, I think, are giving the SBA a filter system to come up with where are we going to pursue. So consider that when you're filling out these questionnaires, to make sure you're answering the questions in the appropriate way. And just know that I think is how the SBA is going to end up looking at this.
So then the next two items that we have here is one, it's really kind of geared around the deductibility of the wages used to get the forgiveness. And I know that the slide point doesn't reference the deductibility of the wages, but remember the loan itself is, when it's forgiven, is not income to the entity or the business. But what the IRS has come out and said is that, yes, we understand that the forgiveness isn't income or doesn't create income for that, but what any expenses used to generate that tax exempt income is also not allowed as a deduction. So that's the IRS's position as it currently stands. And they came up with recent guidance currently, because people are like, well, I'm going to push off my forgiveness, because if it's not forgiven, then I don't have to pick it up as income, and then I can take the deduction and we'll worry about next year. Well, the IRS came out with a provision and said, if you pretty much expect that it's reasonable expected that you're going to get forgiveness, that you would then have to pick up or treat that wage expense as non-deductible if that's what you used, or if you use rent or whatever you use to create that forgiveness approval, then those expenses would not be deductible in 2020. So that's where we have to start off of. And, the hope is that there's still going to be legislative support to kind of reverse course on that. But right now, that's the current state of things. So I think we're looking at most loan forgiveness is going to happen in 2020, and that you'll have to pick up, or you'll have an income effect as a result of the PPP loan forgiveness.
Yeah, and I've heard other accounting firms are giving advice that you don't have to worry that the PPP loan expenses will end up being deductible. I think they're right. I think that's what's going to happen. That provision is actually in the HEROES Act, which is the proposed stimulus bill that's out there right now. And I think the stimulus bill at some point is going to be passed. Presumably when Biden assumes the presidency, this has been said as one of his initial initiatives. So I think that there will be a stimulus bill, and it will have a deduction that is currently not allowed for these PPP expenses. Having said that, that's a rather expensive tagline in this legislation. If you think about it, the PPP loans were about $600 billion. The tax effect on those has got to be at least a third of that, so $200 billion. So by making those PPP loan expenses deductible again, that's a $200 million expenditure in the eyes of the government. And will that go through? I think probably it will, but it wouldn't be surprising if something like this got cut out of an ultimate stimulus package. And so while I don't expect it to happen, it's possible that this PPP loan deduction or these expenses could get cut out of the stimulus, and then that part's gone.
Right, and it's possible that they could only, they might even say 50% of it's deductible, right? So there might be some level of a compromise here. So to just say blankly, no, we're just going to, it'll ultimately get forgiven, and we'll be able to have the deductions, and there's no tax effect. That obviously a great outcome, and that's what we're hoping for, and we expect something of that level. but we don't, I mean, that, you got to be careful on how far you're ready to jump in that boat.
Yeah, and I think it makes it very hard to plan. So we'll have people ask, well, should we apply for forgiveness? And I think the application for forgiveness timing does not make a lot of difference, because what the IRS said is, we don't care when you apply for forgiveness. If you expect to be forgiven, these deductions are not allowed. And so what we were saying prior to this IRS guidance is, maybe if you apply for forgiveness and get it after the end of 2020, the taxability of this is in 2021. And the IRS has shortcutted that and said, no, your taxability of this is 2020. And we don't care if you don't apply for forgiveness or not. All we care about is if you expect it to be forgiven.
So then we'll just wrap up the last slide here, and then we'll open up for one question or two questions. Sorry, we ran out of time to try giving you all this content. But really, from a planning perspective, we're looking at, two primary things that we still have 30 days to do some things. The one is, make sure your estate planning, is a priority. You've kind of known what your total assets are worth and what the potential reduction and exemptions might mean to you in your lifespan and that type of thing. So give that some consideration. It might require some action yet in 2020. Might still have the possibility to do some things in 2021, but I think at some point you want to make sure you have good control of that. The other thing is income deferrals. It's kind of a reverse course, right? Historically, we've said, oh, we want to try to pile up deductions, or we want to push income into the future. Well, now if we push income into the future, it might come with a higher tax cost. Either the limitation of the 20% of QBI, capital gains rates. It all depends on what you're looking to defer, what you're looking to pick up, and it requires some thought on that analysis.
Yeah, this is a year where tax planning kind of has stood on its head. Normally, tax planning involves putting off paying taxes. Does this year mean maybe I should accelerate paying taxes if I believe these rates are going to be higher in the future? And I think it is dependent on what kind of income you're looking at deferring and what kind of time period you could defer that income over. Estate tax planning, though, I think is something you want to take a look at sooner rather than later. You don't want to get caught with a high estate tax if it could have been planned for at the end of 2020.
I'm going to jump back in. Dan and Eric, so much good information. Thank you for sharing all that. We do have time for a couple of questions. There have been a few that have come through as you guys were chatting, a little bit more specific, and we can reach out to those of you with specific answers. But if you do have an additional question or two, please open up the chat box in Zoom. And like I said, we'll have a chance to get to a couple of them. Eric, let's stay with what you were just talking about, the estate tax. It's December 1st. And if the assumption is these changes need to be made before the end of the year, is there even time? How do you suggest people would go about making those changes if indeed they're in that bucket of over 3.5 million or 7 million as a married couple?
Yeah, and there's definitely time to make changes yet in your current estate tax plan to take into account these changes that might be anticipated in the future. And while there's time, though, you want to start these conversations now with your advisors to do so. The biggest thing you can do right now is, well, if you're in this above 7 million, should you be looking at gifting to get your estate under 7 million? Those are big discussions, because it's not just as easy as, well, I'm just going to give all my stuff away. Because once you give it away, you don't necessarily have control over it. The point of the gift being that you lose some control over those assets. And we do, we do encounter these conversations where folks might say, I don't want to pay taxes, and I don't want to, have my inheritors, my kids pay estate taxes, but at the same time, I want to know that I am comfortable and set for my life. And if the cost of doing that is that some estate taxes have to be paid, I'm okay with that. So that becomes the conversations you want to have with your advisors right now is, where do you want to end up? If you're in a position where you can save on estate taxes by making gifts now, how much should those gifts be? Do you want to do everything so that you pay no estate tax? Or do you want to also take into consideration what control you still want to have over your assets? And maybe there's vehicles to accomplish both, where you have some control over your assets, but yet you've still made a gift. And you might be able to do that through trusts or other types of LLC arrangements. Those are the kind of things you want to start exploring right now.
Okay, great. Clarifying question about the $400,000 figure you guys talked about. A person asks that Biden talked a lot about taxable income over $400,000 being taxed at a higher rate. So is the $400,000 number, is that all taxable income? Is that just a Social Security change? Was this just a debate thing? Can you talk about that a little bit?
Yeah.
Oh, go ahead, Dan.
For wages, the 400,000 is that donut, right? So we have 100 up to 137,000, and it stops, and 400,000 it picks back up, and anything above that. So that's a payroll discussion. But then the other 400,000 of income is all business, all income, right? It'd be your dividends, your capital gains, your ordinary income, and that's where we kind of see the tax brackets and everything possibly changing to bring that top tier starting at maybe 400,000.
Yeah, Dan. So I think the point that what's coming through in Biden's proposals is drawing a couple lines in the sand. One is 400,000. If you make over 400,000, you're going to pay more in taxes. How might that look? Some phase out of credits that are otherwise available for you, a higher tax rate. There's also the payroll taxes if you have more than 400,000 of wages. So that 400,000 comes up in a couple of spots. Then there's also $1 million. That comes up in a couple of spots. What happens at $1 million? Well, you lose your ability to do a 1031 exchange. You lose the capital gains rates. So these are just numbers, I think, that you see sprinkled in Biden's tax plan that really have a demarcation of where it looks like he intends to start. And that is, if you make over 400,000, your taxes are going up in some way, shape, or form. If you make over $1 million, they're going up again, some way, shape, or form. That's how I think you'd look at these.
Okay, great. Eric and Dan, thank you guys so much. We've had a lot more questions come through. Unfortunately, we're out of time. There was just too many other things to talk about. I will assure you all, if you have questions, if you're a client, reach out to your SBA contact. If you're not, reach out to me. I will make sure that we get your questions answered. My contact details should be on the screen. So did want to let you know that we have created a resource page where the recording of this webinar and additional information, updates, and events will be available. That's sbaaccountants.com/back. We've got industry-specific events coming up for veterinarians, for dentists, nonprofits, companies in the hospitality sector. So please check those out if you're in one of those categories. And again, I just like to remind you, the SBA team is only a phone call or an email or Zoom meeting away. So if you're a client, reach out to your contact. If you're not, please contact me and I can get you the help or the answers that you need. I just want you all to know we're here to help. That's what we're here for. So thank you again for joining us today. Have a great rest of your day. And we hope to see you soon. Be well.
Thanks. Bye.